Great. Wow, whoa, blinded by the light.
There,
No, I won't. Not least because I'll be in front of the slides, which isn't terribly helpful. Okay, so what we're going to do in the next 20 minutes is just run you through the macroeconomic context for the UK, which obviously sets the scene for the more detailed sort of discussions on the prospects for your individual sector and outlook for NASS. So in that respect, we'll be touching on what the demand outlook looks like over the next few years, inflation prospects, the supply side of the economy, and then, what that actually means in terms of monetary policy and movements in bank rate. Okay, so just to help sort of follow this story, hopefully help you follow this story, I thought I'd start off just by kicking off with the key judgments that the Governor mentioned in his introduction to the May forecast. And those four key judgments were that the process of disinflation continues. Now, for those of you awake in the audience, that's you, sir, you may have heard, obviously, that inflation has picked up. Okay, but actually we're seeing that as relatively a temporary phenomenon. So the MPC haven't raised rates. In fact, if anything, the vote, 3 people at the last vote to reduce those, because we're seeing that as a temporary phenomenon. Second feature of the UK economy, when we look at it, it's in terms of inflation, it's important to look at both demand growth and supply growth. Okay, and it's the interaction of those really which gives you the strength or otherwise of inflationary pressures. So, which is why the Chinese economy could grow in double-digit space, because it had a huge reserve of labour. Okay, so in the UK, we actually have businesses telling us and labour market metrics telling us there is some slack in the labour market. Okay, and actually over the period of the forecast, that will probably pick up somewhat. And that's quite important for the bank's perspective, focused on achieving a 2% inflation target, because that will tend to lean against inflationary pressures and particularly wage inflation. Okay. Thirdly, we think that, as that slack emerges in the labour market side of the economy, that's sufficient actually to bring those remaining persistent inflationary pressures back to our 2% target over our forecast period over the next couple of years. So all of the committee agreed, while there's slight disagreements about the pace of that decline, they're all agreed actually that we are in an easing phase for monetary policy, notwithstanding anything that may happen, of course, on the geopolitical stage, which of course has been very unpredictable. And the final point really relates to tariffs and the impact of those. And we've seen that really weighing on global demand, but also global world export prices as well. So there are effects both in terms of demand and inflation for the outlook. Okay, so those are the big picture sort of judgments. Let's just start off then looking at demand. And in terms of our forecast, it's a probability distribution with a central point forecast right in the middle of that chart. And at the moment, really, as no doubt you are all seeing, and as has already been mentioned, actually the economy is performing fairly sluggishly. And indeed, let's be fair about this, has performed fairly sluggishly actually since we came out of COVID. I think the UK was probably the last advanced economy to reach its pre-pandemic levels of output. And a lot of that has been due, certainly since the second half of last year, probably become accentuated because of elevated uncertainty levels, which really weigh on those sort of risk-taking appetite, if you like. And actually, if I'd have gone back probably to the start of 2024, firms would have said, we expect the second half of 2024 or the first half of 2025 to be better, roll forward, and now we're at the start of 2025. They're actually pushing that back to 2026 or actually even beyond that. Now, in terms of our forecast towards the end of that period, there is a slight improvement. Nothing to be hugely excited about. It's still below our long-term trend growth rate, and there are two factors that help drive that pickup in growth. actually neither of which are particularly hugely important, I would guess, in terms of steel demand. The first is a pickup in consumption growth, which we'll come to in a moment. And the second is that with the planning reforms that we've seen, there should be an acceleration in the levels of housing investment. And those are the two factors that actually drive a modest improvement of growth later in the forecast period. But overall, the picture, I've got to say, is relatively subdued. So what I'll do is just to dip into a couple of the drivers of aggregate demand, so you get a flavour for why the economy in the UK is actually not performing as well as we would like. Starting off with consumption growth, because actually in all advanced economies, it's consumption growth that is the key driver of demand. And what we can see, that elevated levels of uncertainty actually translate into consumer behaviour. So we can see the chart on the left-hand side, actually households are saving a lot more. So that's currently around 11%, whereas the long-term trend rate is around 7%. So to the extent to which they're saving more, they're spending less. So that's one of the things that are weighing on growth. Obviously, ignore the very big spike, because that's a once in 100-year pandemic event where we're all stuck at home but still spending online. But so households sort of spending more, and the reason that they're doing that, we sort of know there's a range of factors here. Chief amongst those is saving more because households are concerned about saving more for potential emergencies. So it is that sort of uncertainty translating itself into consumer behaviour. I mean, the other factor is actually, and the bank is partly responsible here, bank rate is in restrictive territory. It is doing what we want it to do, which is basically encouraging people to save more and to spend less, because that's how we get inflation back to target. Apart from the fact that, unfortunately, also, as and when you refix your mortgages, it will be at a relatively higher rate. But that is the price of bringing inflation back to a sustainable level. So further out, we expect some improvement in consumption growth as actually households don't stop saving, but save a little bit less and spend a little bit more. But obviously, as with all these things, there's a degree of uncertainty, because who knows actually how long current levels of uncertainty will persist. Just turning then on to what businesses are doing, and actually you're seeing exactly the, sorry to be repetitive here, but seeing exactly the same theme. So you're seeing that very high level of uncertainty in various sort of surveys, a lack of confidence, and then you can see on the right-hand side, the chart on the right-hand side, that translates, unfortunately, into behaviour. So firms are more keen to prop up their balance sheets because they don't know quite what lies ahead. And actually, they're spending less in terms of investment. So although investment year on year remains in positive territory, actually, it's relatively subdued. And again, that has been a feature of the UK economy for many years, and it's been particularly pronounced, arguably, since the EU referendum. And that's quite important looking at our overall growth prospects, because it's investment that drive competitiveness, productivity growth and real income growth. So that is a little bit of a concern. The other thing in terms of aggregate demand, just briefly touching on how that will, tariffs will impact the outlook. And certainly if this looks at quarterly global economic growth, and you can see the sort of latest forecast for quarter three, just over 1%, which compared with its trend rate over a 10-year period before the pandemic is roughly around sort of half of that. So it really, those trade frictions really do have an impact on global growth. I mean, particularly for the two largest economies in the world, China and the US. Now, looking at how it might impact on growth and inflation, if we look at the various channels through which it affects each of these factors, you can see in terms of demand overall, actually it's a fairly, whichever channel you look at broadly, actually it's going to provide headwinds in terms of demand growth. In terms of inflation, the arrows are pointing both ways, because actually, although near term it's disinflationary, further out, actually the effect is uncertain, because if you start to see patterns of disruption in global supply chains, if you start to see reorientation of supply chains, that could potentially be inflationary. So there is, again, another uncertainty for the committee to sort of deal with. And of course, ultimately, we don't know how it might impact on exchange rates. So broadly, demand relatively weak, picking up at the end of the forecast period, but still remaining subdued. And actually, I've got to say, when looking at these forecasts, the risks are to the downside in terms of growth. So I wanted to then just touch on very briefly on inflation. I covered off demand deliberately first, because actually we're seeing a pickup in inflation, but what we can clearly discount as a driver of that is what's happening in demand terms, because it's not like that the economy is running hot. Far from it. It's sort of trundling along. But we are seeing, nevertheless, a pickup in inflation. So what is going on there? So, we saw this huge spike in 2022. Obviously, the Ukraine-Russia conflict. We saw this in energy prices. We saw it in the UK, Europe, and other energy-intensive economies. Bank rate rose, and gradually inflation has come back to target. But is now starting to rise again. Latest figures were 3.4%. Our target is 2%. And actually projected to rise later in the year and peak at around 3.7%. But nevertheless, the committee is not raising rates. The most recent vote was 6-3, with 3 committee members voting to reduce rates. They're looking through this as a relatively temporary phenomenon because of the things that are driving it. Okay, so what is driving it? So if you look at this chart, you can see that the big drivers largely are energy. And that partly also relates to the way that the off-gem price cap works. So I've got to say, this pickup you're seeing in inflation is very much a UK phenomenon. You're not necessarily seeing that in Europe more generally. So there's energy as a driver, and the other factors largely up here are other regulated price changes. So those include things like your phone bill, council tax bill, your utility bill, all those sort of things. Those are the main drivers. Now, our expectation is that actually, unlike 2022, this isn't going to cause a wider sort of second round effect for 2 reasons. One, actually, at sort of 3.5%, actually, it's nowhere near the double-digit inflation we saw in 2022, first off. And the second thing is the labour market context, which I'll come to in a moment, has hugely, hugely changed from 2022. So it's a very different environment. In terms of energy itself, the forecast is based on a range of conditioning assumptions. And in terms of energy, those are basically market futures curves. And at the time of the publication of the May report, those futures curves had actually moved down. Now, obviously, there's been a lot of volatility with the conflict in the Middle East. The price of oil per barrel has shot up, but then also has fallen in light of the recent sort of agreements. So we're seeing that as a relatively temporary phenomenon. So as a consequence of that, let me move on to this, because I know that time is relatively short. We are expecting domestically generated inflationary pressures, and particularly wage inflation, to start reducing. And you can see the sort of problem is that, for many, many years, firms really had labour costs under control. They tended to fluctuate between 2 and 3%. And at 2 and 3%, you can probably absorb that in efficiency gain. You might be able to pass some of that through in price, or, for some where that's not possible, absorb some of that in margin. But it's all eminently dealable without necessarily contributing to a high degree of price inflation. Obviously, the situation we got in 2022, you've got wage inflation of 8%. Other cost pressures on businesses margins squeezed, they've got no choice really but to start passing those through. And that's where you've got that external shock embedding itself into domestic price and wage setting pressures. Obviously, as the economy has slowed, bank rate has risen, that has started to come back. And our own agent survey that Diamond there suggests that wage inflation should average this year around about 3.7%. Now, for the committee, that is like great because that's heading in the right direction, but it's not yet at a level which is consistent with achieving a 2% target. So it's not job done, if you like, if you're a committee, if you're a committee member. So there is further progress, but it is going in the right direction. And actually it is approaching a point now at which firms are again getting control of that wage inflation piece, partly because they're facing other cost pressures and uncertainties, and partly because that labour market context has changed. And obviously this is a key indicator of those domestically generated inflationary pressures which the committee focuses on, because those tend to be much more persistent. So I said one of the factors that is contributing to wage inflation abating is the radically different labour supply context. So I'll move on to that next. With slack emerging in the labour market, and there's a whole series of indicators here which sort of tell us that the labour market, there is loosening. There are two big uncertainties related to this. One is the fact that a lot of the data here is from the Labour Force, ONS Labour Force survey, and they have had huge problems with that. Indeed, at one point had to suspend the survey, which obviously, causes us some problems, because in judging inflationary pressures, you need to look at the demand and the supply side. The other big, issue when we look at the supply side of the economy is that the UK economy has been hit by a number of huge shocks. It's difficult to keep track of them, actually, when you think about that. Brexit, the energy supply shock, COVID, etc., etc. And there is a danger, actually, that that's engendered a degree of structural change in the UK economy, which is always difficult to sort of detect, but it looks like that may be the effect. And that actually affects the level of growth that we can attain sustainably, if that is the case, if there has been damage on the supply side. Why we think there is more slack, and bear in mind, this is quite interesting because a lot of labour market indicators are sort of lagging, if you like. The data is quite dated when it comes out, and it's quite lagging. But if you look at where the data is going, the LFS employment measure is very volatile, as I mentioned. But if you look at other underlying measures, that pointed to employment intentions being flat. And actually, if you look at more recent indicators, for example, advanced indicators like Google searches on redundancy, or the latest intelligence that we're getting in relation to what firms are doing, and that in some cases is restructuring and laying off labour, you can only anticipate actually that unemployment is going to rise somewhat. Demand for labour is going to continue to soften, and that will, create that slack in the labour market, which should lean against those remaining domestic inflationary pressures. And you can see this in a range of indicators. The bank looks at, they like this sort of vacancy unemployment ratio. Given that not a lot has happened in relation to unemployment, that drop there is largely reflects a huge drop in vacancies because firms are not hiring at the moment, not surprisingly, with the uncertainties out there and with the greater cost of employing people because the national insurance contribution rises. So you can see the very different context we are now from 2022. Our own unemployment projection, which have tended to be historically hopelessly inaccurate, actually does look like this can't be far off the case, because unemployment is already 4.6%. We're projecting it'll rise to 5%, so it's not got that much further to go. And actually, you can see from very latest data that that seems to be in train. The other area we may get some improvements, which will increase slack in the labour market and the supply side, is productivity in the UK economy has been absolutely abysmal. Again, it's a longer term problem. It's been a noticeable problem in the past few years, which is really odd because you only tend to get negative productivity in a recession, and the economy has not actually gone into recession, but productivity growth has been spectacularly poor and actually gone into negative territory. So very briefly then, where does that leave us? So in growth terms, that picture has not changed hugely since the pandemic. Growth is relatively weak. There's a huge overhang of uncertainty, which is affecting confidence and risk-taking behaviour, and we're seeing that, across the economy. I mean, the good news is if that uncertainty lifts for any reason, actually you would expect then the economy to recover reasonably quickly and growth to improve. But there is a lot of geopolitical and domestic uncertainties facing businesses. So growth picks up over the forecast period, but is still relatively weak. We are looking at this, what we think is a short-term pickup in inflation. There are all sorts of uncertainties around this, and there are different views depending on the particular committee member in question. And it may be actually that the pace of decline in inflation is slower than we might like. It proves to be a lot stickier for all sorts of reasons. But ultimately, that inflation should come back to 2% as that slack builds in the labour market. And you can see that happening at the moment, and you can see that labour market dynamic sort of changing and that being reflected in wage settlements. So all of the things being equal without, significant new geopolitical news, actually you will get inflation coming back to target, and therefore all committee members, I think, are agreed that, with that, actually bank rate will continue to come down. The pace of that will obviously depend on actually how the detailed data suggest these things are developing, which is why monetary policy is on no particular preset path. Probably the thing I'll just sort of end with is obviously the bank itself does not forecast bank rate, but the market does. That curve again fluctuates from day to day to week. At the time of the publication of the May report, markets were basically forecasting by the end of the forecast period, start of 2028, that bank rates would be down to 3.6%. But as I say, that fluctuates with the sort of news, of which there has been rather a lot. So, with that, I hope I haven't run over too much. I'll take any questions if there are any.